All right. Hi guys, and we decided to do it again, and this week we're going to talk a little bit about sales, forecasting our sales, how we can do a better job of that, some things to think about in terms of profitability. It's an exciting it's an exciting area, an area I'm really passionate about because in my own companies we forecast our cash flow. And embedded in that is the idea that to forecast our cash flow, we have to be able to predict our sales or do something to help us so that we are not missing our numbers, that we're making the numbers. So didn't have any slides for you today, but when we edit this up, we'll add in some slides to kind of illustrate what we're talking about. But probably the first thing we need to talk about in terms of where I want to go today is to talk about something we call a contribution margin. You won't find this necessarily in any entrepreneur handbook or starting a business or anything else, but a contribution margin is really an important topic in your financial management of your business. And what a contribution margin is it's basically your sales less your variable costs. That gives you a contribution margin. So if every month your sales are, let's say 12,500 or 10,000, let's say $10,000, and your variable cost at $10,000 is say $2,000. You're going to have a contribution margin of 80% or 8,000 in this case. And then we want to convert that contribution margin to a contribution margin percentage. And we're going to track that over a course of time. So let me just back up for a moment and talk about what variable costs are. So we have fixed costs in a business, and that would be like your rent. That's never going away. That's going to always happen. Hopefully your marketing, advertising, sales, they're all in. So those are at least your marketing's probably looking more like a fixed cost, but at times it's variable because you're going to adjust that spending based upon the sales you'll need. We'll illustrate that a little bit later. Your labor oftentimes is a variable cost because the more you sell, the more you're going to need to increase your labor until you reach a point of where you're scaling. And scaling would be something where you hit a certain point where now all of your labor's largely covered, and any growth sales-wise you can cover with the labor. And that happens a lot in technology companies like Google and Microsoft and other companies where they're selling more of a digital product or software or something. And at a certain point, they don't need any more labor. That labor becomes more of a fixed cost. And sometimes it looks a little bit like a ladder where as you increase sales, for the most part, you don't need to increase labor, but then you hit a point where you've got to add more labor. And we call that scaling. But for today's example, we're not going to worry about that so much. We just want to identify variable costs. And variable costs are really costs that rise with our sales. One great example is like a merchant account fee. This would be like the credit card fees your business pays to accept new customers. A really common rate out there. I know we have probably 3 or 4 merchant account providers, I think, in our business. And a common rate for us is about 2.9%. So let's just round 3%. That's a variable cost. So if I sell $100 of services or product, then I'm going to pay $3 to my merchant account provider, whether that's Stripe or somebody like that, or Intuit Payment Services. That cost is only going to rise with our sales. And if you don't have a merchant account, let me just take a moment and talk about merchant accounts for a moment. I'm in one of my businesses is an accounting firm. And there are a lot of accountants who are really cheap out there, CPAs who are trying to save a dime. But let me tell you about my business. I'll bet 98% of our business is done by credit card. So we send our invoices, somebody calls in or connects into our payment provider, they pay the invoice, and it's easy to do business that way. And I've seen businesses that don't have merchant accounts, and it's a mistake because it really limits your sales. And if you're worried about the 3% fee, then just raise all of your fees 3%, because trust me when I say this, most businesses, whether you're a restaurant, a doctor, a dentist, a CPA, an attorney, most of them get, by and large, most of their fees from a merchant account provider. and Stripe's a good one. We have others. Intuit Payment Service is a good one. But at the end of the day, you're going to probably pay somewhere around 2.9% upwards of, I have seen people pay upwards of 4.5%, but usually it goes along with your credit. So it's a good reason to improve your credit score to lower your merchant account fees. Also, the more volume you do, the lower the fee. But at the end of the day, it's a variable cost. It climbs with your sales. We talked about marketing. The more you increase your marketing, it should result in sales. So labor to a degree, variable. Let me tell you some things that aren't variable. So for example, our phone service, we have both mobile and IP land-based phones in our business. Our phone bill, our utility bills, our rent. Well, we actually own the building, but that's in another entity. So my accounting firm rents the building from another entity that I own, which is in a partnership, because we don't put real estate in S corporations, and my company operates as an S corporation. So rent, utilities, the phone, those are fixed costs. And so we don't want to add those necessarily at this point in the equation for forecasting our sales or what they need to be. We just need to be aware of what are our variable costs. Again, those are the costs that rise with sales in some percentage, just like those merchant account fees. Every sales dollar adds 2.93% in cost to provide the merchant fee. And then we got to add in the marketing, the other variable costs. So we want to first just identify what's variable, what's fixed, and we're only going to pick up the variable for determining our contribution margin and our contribution margin percentage. The best way to do this is kind of track it month over month. And so you're going to go into your financials, whether they're in QuickBooks or Xero or something else. We're going to take our sales all in, less our variable costs, and that will give us our contribution margin in dollars. But now we have to convert it to a contribution margin percentage. And the way we do that is we divide our contribution margin by our sales. Now, a contribution margin, I like to describe it as the margin or the profitability less, the profitability of our company less the fixed costs, so not including our fixed costs. And that contribution is what we need to contribute to the fixed expenses and to our profit. So we'll do an example of this in a moment. But carrying this to a contribution margin percentage, so we calculated the contribution margin, just sales less our variable costs. We track this every month, and that gives us our contribution margin. Then we take the contribution margin, we divide it by our sales, and that gives us our contribution margin percentage. That's a really important number, that contribution margin percentage. And over time, it's going to trend closer and closer and narrower as you mature as a business to a specific number. So for our example, let's just say that, you know, over time, our contribution margin is 80%. So after accounting for our variable costs and our sales, 80% of every sales dollar is left to cover our fixed expenses and any profit that we need to have in the business. So if we needed to forecast and predict where our sales need to be, we take our fixed costs. So let's say in any given month, I need to cover $2,000 in fixed costs. So maybe I rent an office, a smaller office, and I've got some utilities, some overhead cam charges, and some other fixed expenditures, and those all total about $2,000. And then let's say on a smaller business, I need $8,000 to pay myself in profits or whatever. So now all in, I need to cover $2,000 of fixed expenses and $8,000 of profit, and I'm in at 80% contribution margin. So to determine what my sales in dollars need to be, I take the $2,000 in fixed cost, $8,000 profitability that I need for a total of $10,000. Divide that then by my contribution margin, which in this case is 80%. And that would tell me that I need basically $12,500 of sales every month to cover my needs for profit and my needs to cover my fixed expenses. And that's a really important analysis to go through, guys, every single month, because it's going to tell you what number you've got to hit. Come heck or high water, that's got to be it. And it's surprising how a lot of people just manage day by day and they don't understand this relationship in their finances and what it takes to make a living. And so they're up some months, they're down some months. 1 month they might be up 50 grand and then they go spend it all on a new car, new truck. Believe me, it happens all the time with some client somewhere where they get a whole bunch of money in, then they go buy a new truck. They haven't provided for their taxes. They haven't covered their fixed expenses. And all of a sudden they're broke the next month. And so this feast or famine thing, you got to kind of manage. And this is a way to do it, is to determine, what do I need sales wise every single month? So in this example, we said, okay, the 10,000 in fixed costs and profit that we need divided by the 80% profit margin. That means we need 12,500 in sales. Next step would be to understand, what is our average sale? And so let's suppose for a minute you need to hit, or your average sale is probably, let's just say it's 2,500 bucks. You're offering a good service, and all in, some people are at 3 grand, some people might be at $1,000, some people might be at 5 grand, but all in, over time, average sale is 2,500 bucks. That would mean on average, you'd need to have 5 sales, because we take that 12,500 that we need to produce in sales, divide by our average sale. Now we know how many units of sales we need. So if you're a consultant, and that means some kind of a planning project that you sell over and over, or some kind of a consulting gig you sell over and over, you've got to sell an average of 5 of those. Now, that's where the magic starts to begin, because we know our sales, we know how many, we know the dollar number. Now we've got to know what it takes to put into this mix. So let's say on 5 sales, we know that and I talked about it in the last live we did just a week ago, we have something we call a yield ratio or a harvest ratio. And this yield ratio would represent the dollars and the effort that go in for the sales that come out. Let's say it's a 20 to 1 spend, or we need 20 leads to get 1 sale out. That means for every lead, 5% of the time that's going to turn into a sale over time. So we know we need to generate 20 leads. And we know through all of our marketing efforts, whether it's on Facebook or some social media platform or Google AdWords or Bing or wherever, we know blended in, all in, we're spending $5 per lead, and we need 20 leads to convert through our funnel to 1 new sale. That means we're going to need to be spending at least, at $5 a lead, we're going to need to spend at least $100 for 1 sale. And if we need 5 sales, we're going to need to be spending at least $500. And so it's helpful to understand through using the contribution margin analysis, understanding what your contribution margin percentage is, understanding what your total sales is, your average sale price. Then you understand what is the effort that's required and what is the spend I've got to make in marketing just to generate those 5. Now, I'm a guy that likes to over deliver, because you don't want to underperform. So if the required ad spend was 500, I might spend more like 750 or $1,000 just to make sure I hit the numbers. And I'd rather oversell than under deliver on my profit. I think I'm probably like a lot of folks. But the last thing you want to do going into a bad economy, which eventually we know, just with cycles and the cyclical nature of our economy, eventually we're going to go into a recession like we did in 2008 and 9. And we're going to need to increase our ad spend anyways. But the worst thing we could do, the absolute worst thing, and it's probably what a lot of accountants would tell you to do, is cut your spending. And I would tell you, absolutely not. You can cut some things, but what you ought to actually do is increase your ad spend, your marketing dollar, to make sure that you're getting the leads you need and converting those into a sale. And so in this case, I would rather overspend and increase my fixed or variable spending to ensure that I'm getting enough leads coming out. So that's really kind of the process. We start with calculating our contribution margin, then consequently our contribution margin percentage. To get our total sales needed, we need to add into the mix our fixed costs and the profit that we need to derive out of this. Then we need to know our average sale. And then from that, we can determine the number of units that we need to sell, whether it's a project or a desk or a computer or whatever it is we're selling. We need to know how many of those we've got to sell. And then that then translates into our looking at our yield ratio for determining what we need to spend and what that produces in terms of ultimate customers, and then never going below that spend for our marketing reasons, because we've got to hit our numbers and there's no other way to do it. And if we see our contribution margin is slipping or our yield ratio is slipping, then we've got to adjust the numbers accordingly. And if you're tracking that month over month, you'll have the capability to make some wise decisions in your business. So I like to, just teach these things to our clients so that they kind of have an understanding of how they can take the numbers that they've been deriving over the course of time in the history and then translate it into real decision making that they can then put to work in the business and make sure that they're hitting their numbers. Now let's take this up a notch and let's say, okay, we want to grow. Like I have one entrepreneur, he's a client, he wants to double his business every year. Well, now that we understand our contribution margin, all we have to do, the percentage, all we have to do is increase the profit, determine what our sales need to be, and from our average price on our average sale, then we derive the number of new clients we need. If we drop that into our yield ratio, that tells us the number of leads, and it tells us then what we've got to spend to increase and double our business in a year. Very basic math, but it works over and over again. Now, if I was starting my business over again, I'd probably over deliver on marketing in every aspect until I found something that works. Now, one of the things I tell entrepreneurs is test galore, test everything, except don't test stupid stuff. Like obviously you're not going to take an ad out in the phone book. I don't even think we have phone books anymore, although I do get one from time to time. It literally goes in the recycle bin overnight. But the yellow pages 20 years ago may have worked, but they certainly don't work today. I also am kind of jaded in that I think some people spend money where they shouldn't. Like, for example, they, in the beginning, they might spend 10 grand on a website and expect, 100 grand back in return. And nobody ever built a website and just expected people to come and got that result. It's usually pretty difficult. A website might get you credibility, but sometimes it makes sense to spend your money a little wiser and maybe go something like with Wix and build your own website in the beginning, or focus more on social media. I'm a big proponent of social media, whether it's Facebook, LinkedIn, YouTube, Instagram. They're all great platforms for starting and getting going. I also think probably one of the best platforms for really marketing is just getting out there and networking with people who can send you business. Like we have a strong network of attorneys. We have a strong network of bankers. We've got a strong network even of CPAs. It's funny, but CPAs and attorneys refer a lot of work to our firm. And that's a great source of referrals and new business for us. And so we do a lot to nurture those relationships. We'll send birthday cards and Christmas or holiday cards. We'll send, thank you gifts and cards. We call and take people to lunch. We do everything we can to nurture those relationships, those referral networks over time. So I would look at how could I get more business? Like, for example, if I was a loan officer, I absolutely know that I would want a certain number of realtors referring business to me. And I would go out and I would build relationships with realtors until I was getting that number of new purchase loans in my inventory. So if I needed 5 new loans a month, and I knew that the average realtor referred 1 new home to me a month, and some of them will refer quite a bit more because we have realtors in our practice who are selling 5-10 homes a month, easy. But if I knew I could get 1 new loan from the average realtor, I'd go out and I'd build 5-10 strong relationships and assume that maybe there's going to be a month that some of them are off their game. But 5 or 10 relationships is really doable, guys. And I would just work and nurture those relationships and help them in every way to know that I'm their loan officer. Similarly with realtors, I'd look at where do I get business from? What is it that I do that draws in business? I've seen realtors do all kinds of things, including even building relationships with loan officers, because sometimes People will go to a loan officer first and get qualified for a loan before they go looking for a house. Some will build a whole social media presence on Instagram or Facebook. There's a lot of things to do. But I would tell you this. I wouldn't necessarily always follow the advice of people that are in the business. I might go to people who are close to the business and ask their opinion on what they think might work in terms of bringing in new business. Start thinking about that and then start testing it. So if you think, I'm going to try the referral relationship as a loan officer with real estate agents, I'm going to go out there and I'm going to hit it. That's a good strategy. I'd hit it. I'd give it some time to work, see where it goes. I would also probably do something on Facebook or Instagram and really promote my image. I even know of a loan officer from one of our clients who told us that the guy went door to door during the pandemic. Can you imagine going door to door in the pandemic with his mask, stepping back from the door, and then telling people he basically helped people refinance their mortgages, and his business went bananas. He was refinancing and selling more homes than just about anybody in the practice because he was willing to get out there and hustle a little bit. And hey, if that works, it works. It's probably not sustainable forever, but you do what you do to get started. I will tell you one other marketing method is often overlooked besides just the referral, the person-to-person touch and connection that you build. And that is your return or repeat customers. So if I was a loan officer and I had a bunch of people I'd written loans for over the last, 5 years, the average person refinances probably every 3 to 7 years, or they buy a new home every 3 to 7 years. Now, I never thought on my own home I'd refinance the mortgage. I mean, we were in such an incredible rate, and I thought we'll pay off our home in the next few years anyways, so I won't refinance this thing ever. But then in December, rates dropped down to like 2.5%. And guys, I was able to pay back the costs for refinancing in about a year and a half. And I figured, well, I'll be in this loan maybe another 3 years, 4 years. So it makes sense to go ahead and refinance. Well, if my lender, my original loan officer, had kept the relationship with me, he might have gotten that loan. So I would always look at your past clients because you never know when their facts and circumstances changed. And it's a great source for repeat business. And let's face it, they've already got a relationship with you. They've done it before. They know you deliver quality work. Why not go grab it again? And second, it's a great source for new leads because all of your old contacts, eventually they're going to know somebody that's buying or selling a house. So I'm buying a house with some family members right now. So this will be another house for us. And I have a real estate agent. He's just maintained the relationship for a number of years. So who do I call? The guy that's maintaining the relationship. So I think building relationships with your former and past clients, vitally important. Building referral relationships, vitally important. And you don't have to go on the web. You don't have to build a website. You don't have to build a social media presence at all. But it's a great source of business. Same thing for realtors. It's a human connection sort of thing. We have to connect with enough people and carry those relationships. It's just the nice thing today is, unlike a realtor 25 years ago, today you can carry those relationships entirely in a digital world. Building a Facebook group, building a Facebook audience, building a LinkedIn audience or an Instagram audience, and then continually reaching out and working with that group is a great strategy for a realtor or a loan officer or anyone else in business. So I would be out there and testing a lot of things until something starts to work. And then you can start to measure that and you'll understand how many leads yield how many customers. We're at a place in our business where literally almost every lead wants to be our customer. I've never experienced this in all my years of business. It's just changed for us as a business. It's like everything is connecting. But now we're at a place where not every customer makes sense to us. For one, niches are kind of our focus now. So our niches are definitely real estate of all sorts: commercial, residential, selling real estate, financing real estate, syndicating real estate, flipping real estate, everything real estate 1031 transactions, using special purpose trusts to avoid capital gains. We know real estate cold, and it's an area that we are deep in that niche. So if you call us and you're in the real estate field in some way, we got you. That's a great niche for us. Another is small business and entrepreneurs. That's an area of tight focus for us, particularly medical, dental, real estate, again, loan officers and realtors. Those are great areas for us. We also do a ton of work in complex equity that's paid to people. So things like stock options, and employee stock purchase plans and restricted stock, another deep niche. So here's where I'm not good. Okay. Uber drivers. Okay. There are a lot of Uber drivers out there and a lot of Lyft drivers. That's just not our niche, you know. Could you become a customer of ours? Yeah. It just might not make sense. So we're at a place now where we could have every lead, every referral be a client. It just doesn't always make sense for us. And so we might more aptly refer you to somebody that could do a better job. So we're really about identifying the right clients into our practice now. And that's a great position to be in. And it only happens because of marketing and making this consistent effort. And what you'll find is once you kind of understand what it takes to produce a referral and then, or a lead, and then develop them into a customer, then you can work on, further niching down, really focus on bringing value. And that value really results in, value not only to your customer, but to your firm. And then we even tell people, we don't think we're the best CPA for you, or the best accounting firm for you anymore, or right at the get-go now, we don't think we're the best firm. We just don't handle a lot of Uber drivers. We do handle a lot of Airbnb folks. There are people making vast fortunes in Airbnb, and it's real estate. That's a niche for us. Now, one other advantage of kind of niching down is it tends to not only bring greater value, as I mentioned, to the client, because they know they're coming to somebody that does it over and over and they're the best, is generally results in healthier fees for us. And we lower our costs because we've done it, we've been there, we know it. So for example, I'm working on a big transaction, some guys selling their business, and they're going to have a huge capital gain, double-digit capital gain, millions. Well, just so happens we're good at capital gains tax planning. And so we're devising a structure for them, a plan, and we'll be able to defer the taxation on this business transaction and kick it down the road for a long ways and generate a lot of passive income in the process, create a lot of tax advantages for them. They'll still sell the business for millions of dollars, but they'll defer the tax on that for a long time. And it's just something we know because our niche is small business owners, capital gains transactions, real estate. It's perfect. It's right in our niche. And it'll create great value for us. It'll create tremendous value for our client. In this case, they're going to save almost $10 million in taxes over the course of time. So it's a perfect situation for them. It's a little bit of an unusually high transaction, but it's a great thing when you start to niche. Plus, when we're talking to a prospective lead or a prospective customer, and let's say they're in an industry like my wife's in, ophthalmology. Well, when I'm talking to an ophthalmologist about their business, I'm talking about their LensStar machine, their other equipment, A scans and B scans. I know that sounds funny, whether they're a retina doc or they focus more on the front, like the cornea, and do a lot of, things related to the cornea surgery, or their glaucoma. There's a lot of specialists, and there aren't a lot of CPAs that can talk about eyes. They don't understand that business. They don't understand the equipment that goes into it. They don't understand the tax planning that we're employing with ophthalmologists. Same with real estate. When a client comes to us and they own a lot of, I've got a client that owns 6,000 doors. That's a lot of real estate, a lot of multifamily properties. When he came to us, he'd never done a cost segregation study. We do cost segregation studies all the time. We do 1031 transactions all the time. We know the planning around those things. So he comes in, we do a cost segregation study, and we create bonus depreciation where there was none before. And we create almost a $500,000 tax deduction to offset all the income this guy's bringing in. That's just stuff we know, guys, because we do real estate. And so it makes a lot more sense from a sales perspective when I'm talking to somebody specifically about their business, their industry, and they know, I know what I'm doing. They can see it. Candidly, it's an easier sale too. Plus, when we get into the work and actually do the work, since we've done it so many times, our costs tend to look a lot better than somebody that's doing it for the first time. Just like an ophthalmologist, if they're doing a cataract surgery and they're a retina doc, which I wouldn't recommend a retina doctor doing a cataract surgery. Is he qualified? Probably in his residency did a cataract surgery. Whereas my wife actually specializes in the front of the eye and cataract surgeries. She's evaluating patients all day long. Who do you want to go to? The retina doc or the guy that's doing 8, 10, 20 cataract surgeries a day? Because we know doctors like that. In fact, we knew a doctor in Kirkland, Washington, who had perfected a one-handed cataract surgery, and he practiced it over and over and over in his residency on cadavers, just learning how to perfect the surgery. We heard about another ophthalmologist, and it's interesting because he does so many cataract surgeries, so many eye operations that they put patients literally on a circular bed, and he'll quickly perform the surgery, gloves off, gloves back on, and they rotate the patient, and he does another surgery, and he does that all day long. What do costs look like for a guy like that? Pretty low. What's the chance that I want that guy doing my cataract surgery because he's done 20 for every, one that somebody else does in the marketplace? I want to go to the guy that's the expert, that's not going to mess it up, that has created the efficiencies. And truthfully, for me, as a professional, as a business owner, I want to develop those specialties too, because it results in lower cost and a lot of efficiencies. One final thing I kind of want to talk about is we haven't factored in here really attrition and recurring revenue. So I tell entrepreneurs probably one of the best sources of revenue is what we call recurring revenue. And reoccurring revenue or recurring revenue can happen, in any cycle. Like a lot of tax and accounting people, they might only see their client once a year, so it's annually recurring. We also do a lot of accounting and bookkeeping work in our practice, and that tends to be monthly recurring because somebody's paying us to keep their books up every month. I can't think of it, but there's probably a daily converting. But think like the barber. If you develop a good relationship with your client, you're going to be cutting that person's hair every 4 to 6 weeks. My wife goes to the same, salon every 4 to 6 weeks to get her hair cut. She always chooses the same lady. Why? She's built a relationship with her. She's built trust. She knows she's going to do the job correctly. But the point in recurring revenue is revenue that's recurring. You can plan on every month for paying your fixed costs, for giving you a profit margin, for covering not only the expenses in your business, but also the profit. And a lot of people want to swing for the fences and get the home run. So maybe they focus all of their efforts on the one-time sale, like a realtor who's going to generate $10,000, $12,000 of income, but they forget that there's a way to build recurring revenue. So, for example, I've heard of realtors who specialize, they niche down on working with investors. And so they are looking for the one-time sale, 12, 15, 20,000 in commission, but then they create a way to reoccur the revenue. In this case, first and foremost, by working with prior customers, they know that somebody's going to buy and sell real estate probably every 3 to 7 years. So they're going to keep that relationship. Number two, I've seen investor niched realtors create like a group or organization where they meet together every month or every week and go over deals, and maybe they charge them 30, 50, $100. Who knows? But it's just part of creating recurring revenue. So it's revenue they can count on all day long. And then the one-time hit always happens where you sell the big piece of real estate, you make a large commission check, but you've got something reoccurring every month, every year, or every few years that's going to bring in revenue consistently. What I teach people is do everything you can to create recurring revenue. So if you're the consultant, build a site, a membership site where your clients are all actively involved, and charge them, 50, $100 a month, $200 a month. I got guys that are charging way more than that, but some kind of recurring fee. I've got coaches that charge $2,000 to $5,000 a month to coach their clients. That's recurring revenue. It's money they can count on. And then just plan on the attrition. Over time, you're going to see some part of your, recurring revenue go away each year. For us, people pass away, they die, they get divorced. And inevitably in a divorce, a lot of times in the beginning, both spouses want to keep us as their accountant or their CPA, which if we can do it right, we may choose to do, but inevitably it probably makes sense for one of them to go somewhere else. It just happens. Every once in a while, for business reasons, we might choose not to continue a relationship with the client just because we've niched down a little bit more, or they want to go somewhere else, and that happens. Our attrition rate's pretty low. I'll bet it's somewhere around, 2% maybe tops, but it's because every year we have somebody that dies, gets divorced, or decides to make a change. And then finally, we may choose to not continue with the client, and we do that as well. And as soon as you can get to that position, it's a great place to be, because let's face it, there's some clients nobody wants. And I wouldn't wish them on my worst competitor, my worst enemy. There are some clients you get into the relationship and you realize, this just isn't working. And I would recommend to you, get rid of them as quickly as possible, because nobody wants a time suck. Nobody wants somebody that's emotional and hard on your staff all the time. It's just not worth it. It's better to go develop some new opportunities, new leads, and new clients, and to let those clients go. The sooner you can get to letting leads and clients go, the better the job you're going to do for your existing clients. So I always recommend, as soon as you can, find a way to develop recurring revenue, because recurring revenue is some of the easiest revenue to forecast. And then while you have that recurring revenue, you've got the opportunity to do the bigger jobs and the higher value jobs with your clients. So let me give you the context of this from the perspective of, say, a dental firm, a dentist. So the dentist, my dentist, I go in every 6 months. My kids go every 6 months. My wife goes every 6 months. We get our teeth cleaned. That's the recurring revenue. Every 6 months, they're getting a couple $100 per family member in teeth cleaning. Now I've got one son, he just loves sugar. There's nothing you can do with this kid to persuade him to brush his teeth frequently enough, to floss, to do the things he needs to do to maintain his dental hygiene. And so, every 6 months when he goes in for his, cleaning, I'm almost expecting the dental bill for new fillings. And he just got a filling a week or two ago. I think it was actually Friday. He got a new filling, but, that gives the recurring revenue. Every 6 months of cleanings generates the higher revenue, the filling, which may generate even higher revenue of a crown, a root canal, something else. But let's face it, without the recurring revenue, he doesn't have or she doesn't, as a dentist, have the relationship to do the higher value work. I always recommend, for example, with dentists, that they don't do their own dental hygiene and cleaning work. It's just not worth it to them. They can hire a great dental hygienist to do the teeth cleaning while they're doing the fillings, the crowns, the implants, the cosmetic stuff, the higher value things. And the higher value things are what's really going to then drive the profit. But at the end of the day, they need the recurring revenue, the cleanings, to support the staff, to hire the whole team there in the dentist office, and to cover the fixed cost, and ultimately some of the profit. But it's all the higher value stuff that comes as a result of having the recurring revenue. Same thing happens in every other profession, guys. So like a doctor, you have the annual physical. That's recurring revenue. Recurs every year. You get them in for their annual physical. But then they come in, they need something else. They want to go on a weight management program. They want to work on their acne or whatever. Now you've got some additional opportunities for delivering some value-added services to your client. So just to recap some of the things that I look at from a sales perspective is, know what your contribution margin percentage is. And from that contribution margin, you can determine what your sales need to be to cover your profit, your fixed costs, everything else. And from that, you can determine with the average sale price, how many new customers you need, and then how many leads you need. So by understanding just a few simple financial tools, you can really predict with accuracy your ultimate sales and what they need to be, and then use that then in your cash flow forecasting, which is vitally important as well. We'll talk about that probably in another time. And then finally, developing recurring revenue, even if it's low cost recurring revenue that covers some of your basic monthly spend, but increases the relationship so that out the back door, you're getting the higher value added sales and service. Let me give you another illustration of that. I think it's a fantastic one, but insurance agents are often this way. So their recurring revenue might be the auto and the homeowner's policy. So in the auto, they're getting a new commission check every single 6 months when they renew their auto. The homeowners, they might get every single year. But then they go out and they sell a life insurance. So life insurance has really high commission, whereas auto and homeowners are pretty low. But you don't get to sell somebody the life insurance until you start to build in the relationship, build the recurring revenue, start to build the trust factor with the client. So a lot of property and casualty insurance agents make a ton of money off of life insurance, but they do so by having this consistent recurring relationship with their client. So as goes recurring, the faster the recurring nature. So monthly is better than annual because you're building more of that relationship. So find ways to recur the relationship and the revenue, if preferably every month, then maybe every 6 months, then every year, and you'll lock in the relationship from a value added perspective and selling higher end services. Then factoring in the attrition, you'll know what you have to do also to grow and replace either poor clients or clients that go away because of death or divorce or other factors. And you're going to build a strong business. Now, I always say strong finances, strong accounting, strong business, that actually results in great relationships for us. I want our entrepreneurs to be some of the healthiest businesses out there. Why? Because they're going to make great decisions. They'll more likely refer us to other people. They see the success in their business, and we've done it over and over for people, and it's kind of like a repetitive scenario. For example, we've taken realtors that were doing, say, 240,000, 300,000 in gross commission income, and we pushed them up to 800,000, $1 million too in a very short period of time. It's because we know the systems, the processes, the thinking, the marketing, everything that goes into running a real estate practice. We've done it for attorneys. We've done it for loan officers. We've done it for medical professionals. And all of this is incredibly valuable to people when they can start predictively saying what their sales can and should be. So I'm a serial entrepreneur. I've done this a lot, guys, and I own 4 businesses now. Call us at Private Tax Solutions. Reach out, DM us either on Instagram. I'm John Miller CPA on Instagram or on Facebook. If you're watching this on Facebook, find ways to connect with us if you want to talk about how we can help you predict your sales results a little better, make your business more successful, understand the economics of your business. Give us a shout, because if you're kind of in our niche area, there's a lot we can do to help you. In the coming weeks, I'm going to start interviewing some entrepreneurs, showing you what other people do in different industries. If you're interested in being part of our show, we can do it remote. There are a lot of businesses where we are that have also expressed some interest. Talked to an insurance agent today. He's an incredible agent. He's networking with about 50 State Farm agents, and he's selling all the insurance that the State Farm agents can't sell. I think that's a fantastic business model. I've known the guy for probably close to 12, 14 years, I'll bet. He's building a great business. So I think we're going to try and have him on in 2 weeks. But if you have an interest in doing this, join us, guys, and reach out to us. Either DM us on Instagram or Facebook, or call our office, and we'll see if we can't bring you in the loop, see if we can't spend 45 minutes with you, help your business, either as a client or, in one of our shows we want to just expose you to all the great work that entrepreneurs are doing out there, how they're marketing, how they're building their businesses, how they're managing them, how they're hiring. Hiring is a tough gig today, as we all know. And I think there's definitely some secrets to hiring, some things that people are doing that are incredible, that are helping their business create and maintain a stable group of employees. So, help us in the comments. Join us by either reaching out or calling us. And we look forward to connecting with this community and helping our entrepreneurs grow. And I think there's a lot we can do beyond what we've just talked about today. So thanks, guys. It was good to be with you. I look forward to talking with you in the future. Yeah. Okay. All right. Thank you.